Hey, g'day everyone. It's Scotty from Zenium Real Wealth. How are you on this fine day? All right, tonight is our August 2019 Propertunities evening. So it's a really fancy word, that isn't it? Propertunities. So essentially, this is the third night every month where we have dug around, found the best opportunities in Australia, and and we are having a look around and saying, hey, look, these are what you should be considering based on all the data we reviewed last month. So without further ado, I'm going to do this screen sharing thingo. All right, you guys can see that, I hope, which is all good. Okay. All right. So this is a recap on the data we covered last week. So if you've missed that, you can jump on to our vault and check out the webinar from last week. And if you missed the week before that, the first night of the month, we talked to Rachel Hambling, who sources development sites. That was a really good one. It's worth a look. So this is a quick recap on the HTW clock for the month of August. And due to complaints in previous months, I've made my mouse really large and colourful. So hopefully you guys can see that tonight. All right, so as we've got down here, we've got some of our main capitals down the bottom of the market. Melbourne, Perth, which seems to live down there at the moment, but it will come on its way out. Brisbane, Alice, we've got Sydney heading downwards, getting close to the bottom of the market, and a few other key regional centres in other places moving up. Hobart, down there approaching peak, and quite a lot of activity in Hobart. Be pretty good if you sold tents in Hobart at the moment, because tents are in demand because they can't get rental properties. People are sleeping out in tents in fields and other places. Sunny Coast and a few of those other regional centres at the peak of the market, and a few others going down there. So we're not going to spend any time on that. We talked about that last week. If you missed it, you can jump on and check it out. What I did chuck in was the units. We all know my fan of units. I'm not. But I've chucked them. You can see they're very similar. We've got Brisbane units down the bottom, except the difference is Adelaide's down here instead of up here where it was at houses. Gladstone and Port Hedland, Townsville, Cairns, they're all still in those areas there. So units can be similar, but they can also be slightly different to houses. Sunny Coast, same thing. And Gold Coast over here on the right-hand side, and Sydney in the same spot as well. So units is pretty much similar. That's why we don't normally go into that on our nights. But I thought I'd chuck it in because tonight we do cover a bit of units under the discounted buying. All right, we've got our compass there. We always talk about that. So we've got our clock from HTW and the suburbs and the towns in those areas that are covered there in their position. We transpose that position onto our compass, and it tells you what to do. So we've got Brisbane and all those areas in Melbourne we talked about there. So we're chasing some positive cash flow in those areas there that will ride that wave as it moves out. We ride that cycle as it comes out there. We've got emerging markets, so Cairns, Gladstone, Mackay. So we're over here in the khaki sort of colour, getting ready for a real upswing in values through development and other bits and pieces, or just riding that market wave. And we've got the falling markets over here that we're looking at discounted buying. So getting in, getting stuff cheap. So Sydney and other places, and Gold Coast, etc. So that's just a reminder how our compass works, and we always go back to looking at where a place is on the data and what that means that we should be doing on our compass. A quick reminder with our Palazzo de Wealth, the 4 areas that we're going to cover tonight in our compass line up with our Palazzo. So we've got our discounted buying, our positive cash flow, our asset or land banking or buying that with an upside, and our development section. And there, remember, there are our 4 pillars that hold up the rest of our strategies here. So if you haven't got a copy of that, you can grab one. We get it on email to all our new members. You should get a copy of email of that. And we've got in our vault, our zenium.property/vault, we've got videos on training on how you use that Palazzo de Wealth to your advantage, and you can start planning your property transactions and your portfolio. All right, discounted buying in the blue section. We've got our blue properties for the evening. They're blue because they're feeling down and they're going down. So here's some examples. And I said we'd talk about units tonight, as much as I love units. We have here quite a bit of stuff from down south. a few things from Queensland. So we just extracted some data there, and look at the stuff in the red. Okay, so the red is how much we've got to drop down in price. Okay, so we're seeing those things change. So we had an original price there of 2.5 million, and we've got a sale price that actually sold at 1.86. Okay, and it took a decent amount of time to sell. Same with this, 4 months. Here, that was only 8.5%. Is another big one, 17%, 10%. So 10% on a $400,000 property. That's a fair bit. We're seeing those sort of drops there. Now, I thought we'd show you units tonight because we did houses last month. But as you can see there, why would you ever want to pay full price? I mean, if you're not buying at a discount, you shouldn't be buying. It's as simple as that. So absolutely always be buying at a discount. And there's some examples. And this is a real life example that we found yesterday. It's a unit in Brisbane. So it was originally listed at 270, and it's already, that's the list price of 239. So we've had those sort of drop days on market. It's been there for ages. I mean, I wouldn't be offering 239 if I went in. They may be lucky if they still had a 2 in front. I don't know if they'd be that scared to get a 1, but I wouldn't be scared to give it a shot. All right? That's the sort of stuff that's around. Now, do I want to buy a 1 by 1 by 1? No, but if you had a need to buy that, this is probably not bad buying now, especially if you got that with like a 195 or something, or even a 210 or a 205. That's really good buying. Okay, so I'm not saying you need to go and buy a unit. I'm saying there is buying around. You need to buy according to market cycles. All right, before we go on to the next pillars, we want to remind you about our impact investing methodology. So that is that when we invest in that buy and hold and that discounted buying property that we've just seen, we're investing our money from projects in active capital transactions. So that means that we have a capital amount we enter into. We do small projects, whether it's a renovation, duplex, development, etc., something like that. Make profits off those monies, pay your taxes, and then you invest those profits into those buy and hold. So that way you've still got your capital freed up, and you can continue to do transactions after that time. So that's our impact investing methodology. So I'll chuck that in as a reminder before we go into these next stages. All right, positive cash flow property. So we chucked in something from Perth this month because Perth has seen office vacancy rates dropping substantially in the past 2 quarters plus in Perth, and we're starting to see some activity over there, and the mines are picking up. So we could be at a time where we're seeing that sort of thing. And Perth being at the bottom of the market tells us, remember, that we're looking for positive cash flow. So we're looking over here, 5 bedroom, 3 bath, 3 garage. It's a dual key style dwelling, new construction, just under 500 grand for a 6.5% yield. Okay, so that's a new construction. So that's the sort of thing where you get in, you've got cash flow there while you hold it. As the Perth market picks up again, okay, then you'd actually look at possibly, well, if the rents were really great and kept going up, you go happy days. But I would look at saying, okay, the rent starts to move. We might get out when that rent hits $700 a week. We're still selling on a 6.5% yield. So we might get, what's that? Yeah, so maybe 580, 600,000 for your dual key as you come out the other side. And you've made that sort of money while having positive cash flow for the time you've held it. You can sell it for more. I'm just guesstimating, right? So this is what we do when we come planning to this sort of stuff. So that's that's the reason why we look at positive cash flow when the markets are down, because we ride the wave on the way out. All right, same thing north of Brisbane at Launton. There's a new university going in down near here. So our yields aren't quite 6.5% like in Perth, and the price is a little bit more, but it's perhaps not as an unappealing market, for want of a better word, for Perth. Not that Perth itself is unappealing, but that market has really been slapped around for many years. Whereas Launton, we're near the new uni and other bits and pieces. So this is probably not a bad buy. And we'd come in, as I said, we'd hold that. It's making you some cash flow on the way through. And then when that market picks up and that uni really strikes ahead and that land, that all the land close by gets eaten up with development, then you could look at selling that and Brisbane comes off the bottom of the market and moves out. Well, same thing will happen at Lawton as the ripple effect happens, and you'll see an uplift in prices there. So that's that one. And you can see the dual key, just a reminder, with my lovely cursor. So you've got your two garages at the front, right? They're there, but they're actually separated by the firewall up through there, and that's the one dwelling, that's the other dwelling, right? So it looks like a house, but it's actually nice and split. Remember, dual keys can't be split and strated, so they're always sold as one complete property. All right, another positive cash flow we're looking at in Brisbane at the moment is rooming accommodation. So this here, that looks like a house again, because it is a house, but each room has 5 self-contained studio, like I wouldn't say apartments, but studio rooms in them. Can be on small blocks because we do double-story dwellings on that. We even get to rent out the garages, believe it or not, because the people that rent the rooms don't have cars. We build these things close to trains, preferably stations, bus stops, that sort of thing. Key infrastructure transport areas. As you can see, the rents are very, very good. So we're looking here at around about $1 million to do a project, because that's completely turnkey. That even includes cutlery in the drawers, right? They're completely fitted out mini apartments. Now we're looking about 8 to 9 months to get that done. There you go, bedroom, kitchenette, ensuite, air conditioning, and it's got its own, I didn't bother putting the picture in, but like an individual door lock on each door. So it's completely secure when you're living in there. So a lot of people we're finding were disappointed on rental yields, so we were really chasing around for other ways to do that, and this is one of those ways. We're looking at around about 7% returns, okay, and this is what they can look like inside, okay, and so it's just got everything in it all ready to go. So blinds, I'm not going to go through all that, it's all there. I mean, if you get the replay, you can stop it and look back yourself, but essentially it's got digital push button doors for security, all your normal stuff that you get when you do a turnkey, ready-to-go dwelling, okay? So that's pretty good. I've chucked this in here because in a period of 3 hours, our guys that do this with us, they have 3 inquiries. They put it up on a social media network, and they have 3 inquiries already in 3 hours. These things rent like hotcakes, okay? Because they're about $280 a room. So they're well below a normal house. They're not share accommodations, so you don't have that concern about, is my share partner going to pick up their end of the rent and all that sort of stuff. Literally, you're only responsible for your $280 a week. So it's a pretty good option. And they're brand new builds, so you get all your depreciation and stuff like that. All right. Emerging markets, we've left Mackay in there again because if you follow our mate Terry Ryder, he did a webinar last night talking about Mackay. I think he's up there on the weekend doing presentation of Mackay. It's his hot pick at the moment, and we've only got 3 of these left now. I think we had 4 or 5 last week. We've got 3 left of these new Mackay house and land packages. So they essentially, you're getting to build them with some equity in it, and definitely in the price movement coming out of Mackay. Remember, they're down here in the emerging market side on the HCW clock. It'll come out there for the rising market. You'll get price movement on that. And even though Mackay's had a lot of property oversupply in previous years, because it was like that, there was no development, and now the pendulum swung back the other way and we've got an undersupply. And that's why Mackay is on the cards. And the council has spent a fortune in the town centre for planning and other bits and pieces. All right, we're around to our red section, or our develop and make money in property section. So this section here, we have an infill site in Brisbane, in the Brisbane corridor. All right, so this is in the township of Balbarra. You can see there's Brisbane. This is the site here, and it's infill. You can see there's all houses around it, and it's that site there. It can't be built on. This site can be built on, and it's in demand. You can see there's no vacant land. That's all sports fields, and that's shops. There's gym and Macca's and stuff there. You walk straight down the road. Bus stops along the way, and the river. So it's nowhere near the river in terms of for flooding. and it gets good breezes there, and that's it. It's pretty much some of the last land around. This one here, it's up to stage 2 already. So stage 1 has been done, where the site's settled, the DA's underway. It's I actually was invited to a council meeting about that a few weeks ago now, and they're pretty much deciding which trees to keep and which trees to get rid of. It's always fun with Brisbane City Council, but they're obviously across the development of that site in a fairly big way, and they know exactly what they're wanting to be done. All right, so we've had, we need 1.2 in that site there. There's already 600 in. The second stage, we're needing 600, and the developer's looking at 14% per annum for the year. On that, we're looking to be sort of turning soil about June next year, so have more sold out in about a year's time. Okay, so that's that site there. It's a good site. There's 7 lots coming out of the ground, and the existing dwelling, which is currently rented and is in very, very good condition, will be sold, and that's what makes the good profit on that site there, to sell that dwelling. That's the quick figures there. The purchase price of 1.2. We needed the 1.2 in the cash, all the costs, the civils and all that, and their prices there. So existing house gets that, and the new blocks are that when they come to sell. Okay. So it is a fairly standard sort of return for that size development. So nothing out of the ordinary. That's what we like. Something that's boring, but that does what it needs to do. Okay, that is a really good thing. If you're interested in that, you can pop a comment in the box, contact us after, and we can tell you a lot more information. Remember, this is all high-level overview stuff that we go through tonight, because we only have 30 minutes, and I don't like running over time because I respect your time, and after 30 minutes, quite honestly, I just get hungry. Okay, so we've got down here another red property. So remember, red, we're developing, we're making money on upswings and changing the value of that property. That's why they're red. So this is a renovation in a New South Wales beach location. Man, that beach almost looks better than Noosa Beach. In fact, it looks pretty much better than Noosa Beach. But anyway, not going to go there and say which one's better. This is a great little project. Okay, so we've got the purchase price there of $526. Okay, we've got stamps and other bits and pieces all in here. So fairly simple. We kept the FISO really simple on this, so because we want to show you the difference between a development and a renovation. Okay, so all these other costs that you have, these line items that just aren't there for development, right? I mean, there could be tree lopping in some renovations. This one there isn't. But we just don't have this surveying and legal fees and all this sort of other development stuff that you got. This reno is costed. I didn't bother putting the exact costing in because it's just pages and pages of individual items that have been costed. So if you're interested in being involved in this project, that information will be made available to you. I'm not going to go through every line item here. It has been very, very well costed out, and that's how come this figure is here of the renovation. So this is these properties in these areas are going very, very, very high prices once they're done. This is an example of the type of thing that's going to look like, this type of finish quality. And here's your snapshot here, right? So we're looking at around about a $300,000 profit, which is a fantastic return on the capital needed. Okay, so cash required is a little under $500,000 to get this renovation done. So house settled, renovation done, and out the door. And I believe, I mean, you know me, I always like to be conservative. It's not going to be a 12-month project. It's going to be under that. But it's not going to be a 3-month project. Okay, so it's going to be somewhere between those two time frames. But it's not going to be a 3-year project. Okay, you don't make money on renovations if you take too long. You go in and you get it done quickly. So really your target on a reno, including your settlement and all that sort of stuff, is 6 months. And then you just allow a bit of time for, unforeseen things, which always happen, right? There's always something comes up. So this is a great project. You should really look at doing this. It's a different strategy to a straight development. It's not a duplex construction. It's not a discounted. It's one of those other strategies we use that we are increasing the value of the property and getting out again. Okay, that's the important thing. All right, the next one is our commercial development side. So commercial development here, we've got figures here in the Hunter region. That's obviously not the sheds that we're talking about because we're doing a development and they haven't yet been built. So that's just indicative of a shed. In fact, they're not going to look anything like that. I don't know why I put that in there, but you get the idea that it's not a house, okay? It's commercial. So we're looking around the $550,000 purchase price. We've got around about a $2 million build, and we've got sales there. They're varying, but they're with commercial, maybe you sell on per square meter. So we sort of spread them out based on the per square meter rate there of our 15 lots that we're looking to get on this size block. So we're in very close end discussion with the guys on that. We sort of narrowed down to about 2 to maybe 3 people to give us the final turnkey quotes on this to construct the sheds. And we're just waiting for the agent to get back from his golfing trip in Bali so we can actually get a contract sorted on this one. But we've been talking to him now for quite some time. So this one is a good project. Same thing, around that 25+% margin, overall margin we sort of aim for. Definitely got to be above 20% for banks to look at it. And that project there, I think it's going to be 15 months. So that'll come in our 12 to 18 month category in that project time frame. So that one there is available for you to be involved in as well. I believe the funding on that is needed to be around about $1 million, give or take. So similar to that residential development. So a lot. So the renovation's a lot less. Doesn't need as much money because it's obviously just a reno. The developments need a little bit more, but they're obviously a higher end sales value too. All right, that's how that works. All right, our bonus properties. We always like these bonus properties. So last month we put a bonus property in. We had a client straight away say, I want to take that. So that was pretty exciting. And we're in the final throes of finding the exact style of build and property for that client now. So I expect maybe similar things on something of tonight's webinar as well. So this is what we talk about when we talk about an active capital transaction. So all these things here with the developments that you're putting your capital in, you're earning your return on that, and then you can bank that return. You either pay your tax and you put the return off your home loan and you still got your original capital, you can go and do more with it, or you use that return to go and do a discounted purchase or something like that. That's how that impact investing strategies work, and that's what we do. So this year I've got 2 bonus properties tonight so you can see the difference. This is a higher end duplex on the Sunshine Coast. It's a really odd shaped block, and that's why it's been sitting there. And the odd shaped ones are the ones that you got to have a solution to. So we're in the process of getting final costings on this, but we're fairly certain we're right on some of these figures here. So the land is the 580, the build, the stamps, total cost of 1.3. Okay. So but each duplex, they're full size duplexes, quite a large build, is going to sell for around that 750 plus mark. Okay. Which gives us a gross profit. Okay, so gross. So you've got to take out some holding costs and maybe some strata costs, and depending on what comes in the build, we'll have that finalised. So don't come back and say, oh, you told me you're going to make 200 grand. This is how we do the figures and initials. So the gross profit around 200,000. Then you've got to sell it, a few other costs. So if you're not netting, 120-ish thousand on a project like that, which is about right, usually works out at about 10% on a duplex. So about 10% of the total cost is what you should net after 12 months. Then that's an indication of how a good duplex project will work. Okay, so you go in, the strategy on this, we get the final pricing, secure the land, get the right builder at the right price, and the planning, obviously, put that in, do the project. By this time, we're probably approaching the 8 to 9 month mark. Get it tenanted, okay? Get tenants in there paying good rent, so you're getting some cash flow. And then by that time comes around, we'd put it on the market to sell as an investment property, and you would sell that after the 12-month period of holding it, right? For any of those capital gains and other bits and pieces. So it's a big block, 930 square meter block. No worries in this zone to put a duplex on, and away you go. So I think that's a pretty good project. It's got some things that you need to work out, like the shape of the block, but we're in the process of doing that now. That's what we do. All right, another one. So a lower end price, okay? And this is why I chucked this one in to show you the absolute difference. So this is the block here. It's a corner block, so it's a nice size duplex block, 1,000 square meters again. It's actually benched. It's hard to see because obviously we're looking down on it, but it is like this here. So one block is up, then there's a retaining wall, a rock retaining wall there now, and the other block is lower. They're already flat in that way there. And so this is probably the best plan I've seen, where they propose two separate dwellings. So even though it's a duplex and it would be strata tiled across there, it's two separate dwellings. So they're not connected with a joining wall. So don't just get hooked up on that. But yeah, you can see that's where they go, duplex 1, duplex 2. So land, we'd get that for around 300. We're looking at probably a 450 build. It's a lower priced area, so we're not going to spend the same as we did in the last one. Stamp duties, total cost 760, selling each duplex for around that. So we're looking at around about 70,000 bucks after the year. We've got some selling fees. This one, the margin is less. I think that we're going to get our build a fair bit cheaper than that. I kind of put a bit of worst case, you know me, I like to be conservative. So this would be really marginal. At the moment, this is marginal whether this works or not, pending on, I think tomorrow, unfortunately, when we got that final build price through. If I get that build price in and that comes closer to 400 grand, then this will work. If the build price comes in at this price or above, then it's not going to work. But I wanted to show you that just because something is cheaper, okay, at 760, that's a lot more affordable for our investors to get in and get out. So at that price point, we are needing close to 150, 160,000 to do this project. It still doesn't mean it works. Okay, so that's the key that we want to remember here. All right, so we're coming to the close of the evening, I believe. That's our last bonus property. Have we got any questions on anything? I can flip back through the slides if you want. But if you've got any questions, chuck them in the side panel now, because we've got under 3 minutes before I call it a day, and that's like keeping it tight at 30 minutes. Jason or Karen, have we got any questions come through?
Next week.
The Q&A next week. Well, that's a great sort of promotion there, Jace. Thanks for that. So we do have our Q&A night next Thursday night. That's a Q&A on these opportunities or anything in general in the market. So we did last, I don't know, we must have had 20-something questions last month. I can't remember that. Even when we're doing the webinar, I'm getting questions live posted on the Facebook feed. So the Q&A is a very popular night, but this is obviously recorded and also gets pushed out to you guys on email. So you can look through and see any of that sort of stuff. All right, I've got a comment here. Any general comments on the effect of the stock market volatility on the property market? Yeah, the main general effect, firstly, thank you, Andrew, for that question. The main general effect that comes is confidence and sentiment. So what happens is, for some reason, people see the stock market doing whatever the stock markets do, which they go up and down and all over the place. They bounce around. If you actually looked at them closely, they're just constantly moving. When they see those big movements, people get, skittish, and then they go, oh, I'm not doing anything. When in reality, there's not a huge connection between what goes on in the stock market and what goes in the property market, other than when the stock market can start tanking and going bad, a lot of people do move their cash out of the stock market, and if it looks like it's not going to recover for a while, they end up going and playing in the property market. So they hold it in cash or they put it in a fixed asset like property. So I'm not saying that if the stock market goes bad, the property goes good. That saying goes around, and I think there's very little substance to that saying. I think it's just something that people throw off at the mouth because it feels good to say it. I don't agree with that. But I think there's always a position in the property market and in the stock market, which I'm not skilled in, to make money if you know what you're doing and you're adding value to it, which is exactly what we do. When you look at our strategies, we're either buying severely discounted property or we're adding value to the property. There's only one strategy we've got where we buy and hold, which is potential for an upside, is that land and asset banking. But same reason we're buying that, we're only going to buy it at a discount. So really, we only do two things. We only buy at a discount, and or we add value through development, renovation, construction, right? So if you got that sort of thing under your control, well, then you're already at a better stead than someone who just goes and buys a property because they feel like it. So the effect is on sentiment predominantly, and then property investors. I know some of our clients, they don't even look at the stock market. They'll say, "Oh, I don't know, what happened in the news? Oh, yeah, I don't know. I saw some red lines." Some of them don't care. Others are really hooked up on it, and a lot of them freeze and don't do anything. So I'm not giving personal advice here. This is just general our view of what we see when we deal with clients, and that's their take on it. So yeah. Honestly, I used to follow it fairly closely, and I've got mates that follow the stock market closely, and I have conversations with them, and they'll say, "Oh, did you see what happened in the stock market?" I'm like, "Man, I'm too busy finding property deals." Like, no, what happened? "Oh, this happened, this lost this." I'm like, "Oh, man, I found a duplex site today where a client could make 100 grand." That's kind of my answer. Now, I don't want to be blasé about it because, like a lot of superannuation funds and that, there's a lot of retirement visions tied up in that. So it's definitely a thing, but mate, I've got enough time to focus on what I'm doing. So yeah, sentiment is the main thing. All right, any other questions? Otherwise, I'll call it a night because I don't want to hold you guys up too long. All right. All right, that's it. Look, thank you very much for joining us this evening. This is our August 2019 Propertunities evening. That's a mouthful. So Propertunities, where we show you the best opportunities in property according to the market cycles. That's what we do at Zenium. We trade and focus on the market cycles to give you the best result. And remember, we use impact investing. So that's how we supercharge your portfolio and your personal wealth. I'm Scotty from Zenium Real Wealth. Thanks for joining us.